So about a month ago, as you know, we had very cold weather. In Hartford, the first week of February was averaged only 16 degrees. And we started to get a lot of call from members about midday price changes at the rack. Now, those aren't completely unusual, but they seem to be more than normal. And this affected two types of customers: those who already promised a price to a customer, a client, and then by the time they got to the rack, they saw that the price had changed, and they had to go back to the customer and renegotiate their price, and sometimes even have to change their tickets. The other type of person who was really affected were people on the LIHEAP program. Those vendors in Connecticut, they get their price fixed from the state, and that's done the day before delivery. So if they get a price fixed from the state on a Monday, by the time Tuesday rolled around, there were already two price changes at the rack, and they really lost their margin. In some cases, they even lost money on a LIHEAP sale. So we went to Angus Energy to ask them what kind of advice could they give to our members regarding this phenomenon, and they came up with this very timely webinar, especially timely because now that we got the conflict in the Middle East, and things have really accelerated across all fronts in this area. Danny?
Thank you very much. And obviously, people are taking this seriously because there's 83 people on this call and it's still growing, which is very nice. I just want to state one thing before we get started. There's a rumor out there that knowing that we had this webinar taking place today, that Phil Barrett's called Donald Trump and told him to start the war in Iran this weekend, so more people would join this webinar. That is not true. So, but timing wise, it is pretty amazing what is going on here. It's an important issue. It's an important issue every year, but it just comes more to light as we're talking right now. And this is going to be more conversational. There are slides, so people have something to look at, but it will be more conversational between myself and Phil Barrett, senior partner at Angus Energy. And we want to go through, as David said, he called me out of the blue. Why is this happening? And I think we both realized very quickly into the conversation this was more of a basis issue than anything else. And we don't want to get in, does it happen more often than not? It does happen, and it's something that needs to be taken care of. And when David said, as just showed up on the slide, isn't this mainly being caused by basis? The answer was yes. And very quickly, this webinar was easily put together because of how much we have been concentrating on this and what needs to be done in the future. So with that opening, I want to start going through a bunch of stuff with Phil. What we will be covering, and I'm sorry that I'm going fast, but there really is a lot to cover, and I want to make sure there's enough time for Phil to go through it. These are the 4 points that we'll be covering. In general, we want to make sure, sorry, I just got something from Bryce. Most people are saying that they're kind of familiar with basis. I'm happy to hear that, but there are a lot of different pieces to it, and I'd like Phil to spend some time on that. What does basis really mean? And after going through that, so everybody has a really good idea of what basis is, or at least from our perspective, what they need to be thinking about, that will help everyone understand the following few slides of what happened this year. From there, we'll be able to go through, does it really matter? Obviously, the answer is yes, but we want to go through in detail why it does and then afterwards, what the hell can we do about it? And I think that's become more of an issue that we want people staying away from what really, in many times, becomes a cancer in this industry of the words "I'm fine" or the word "status quo," that I don't really need to deal with it. It is something that we have to work on. So that's going to be for the next 35 minutes or so, and we'll leave room for questions. Um, these will be the 4 things that we go through. So, Phil, if you can just introduce yourself first while this slide is up, and then we can get into the webinar itself.
Sure. Good morning, everybody. Phil Barrett, Managing Director at Angus Partners. Been at this game for better part of 40 years now. I don't know when that happened, but it did. And we've seen a little bit of everything. And just to answer the first question, what does basis really mean? It's not complicated, but it is complicated. And sometimes it's separating the facts or separating the real noise from the static. But basis is it's a price difference. It's generally the difference in price from point A to point B. Basis does not only apply to heating oil dealers trying to buy product in Hartford, Connecticut. It applies to a commercial baker that's buying grain from the Midwest. It just really, here's a product and it has to go somewhere else. Some unique things about our basis is or that we all start with the NYMEX. Everyone's familiar with the NYMEX. The NYMEX is wonderful to CME, the futures contract, the New York Harbor delivered. Everyone, that I am sure everyone is very, very familiar. That is the reference point. That is what you see in the newspaper. That is what you see on the screen. That is what people talk about, whether it's WTI, West Texas Intermediate crude oil that they keep talking about with everything going on in the Middle East, whether it's ultra low sulfur diesel, whether it's it kind of doesn't matter, but the futures contract is the Merc, and everyone's familiar with the Merc, and everyone's familiar that you need to do something. So we're going to define the difference between, or the basis as the difference in price between the Merc and where you're lifting the product, call that the rack. It's not, it used to be back in the day that it was a calculation of distance. How much does it cost to get from point A to point B by pipeline, by rail, by truck, by ship? As a matter of fact, there's the people that are in the Mid-Atlantic are even used to negative basis, where if the product is coming up from the Gulf of Mexico, it might have a basis that's negative because it hasn't reached New York yet. What's happened over the last couple of years, maybe even better part of a decade, is that there have been some things thrown into the basis. It's still the same definition, difference between Merc or NYMEX and where you're lifting your product. But right now, some states, there are 3 official states, but there are many states that have little hybrid programs. Well, you have biofuels mixed in there. So if you're a 10% state, a 20% state, well, the NYMEX contract is ultra low sulfur diesel. It does not have a bio component. That bio component can make things more or less expensive. So that's a concern. That's part of the basis differential. Another thing that we're mostly familiar with, if you track futures at all, is the inter-month futures prices. So when you have a market that is very, very strong, like we have right now, the deferred, the second month, or sometimes the prompt month will be less expensive. The prompt month futures contract might be less expensive than the physical oil. There have been times where the market is very, very weak, and so the basis actually gets negative because of the spreads in the marketplace. But again, I apologize for the long-windedness of it, but it really is important to understand that the Merc is the key to all of this. It is what we all need to look at, but that basis, we have it here. We're calling it the last mile. That is what I want to focus on a little bit today, because it's kind of usually okay, but when it's not, it can get really ugly. And we're in one of those times right now, despite the fact that I did not make the phone call to the president. Okay, so this is Merc. Everyone knows this. This is going back over the past 2 years. This is going over the past 2 years. Obviously, all the way to the right, you see the spike that we're in the middle of right now. It's moving all over the place. Today, just as a for instance, the low price on the April heating oil futures contract is around $3.11 a gallon. The high price is $3.45 a gallon. So today alone, we've had a 35-cent price swing, which kind of goes to David's original question of what do we do with intraday stuff, and we'll get to that a little bit. But this is what everybody's used to, and if you look back at your supply prices, if you look back at your retail prices, if you look back at your fixed and capped price offerings, because obviously those prices don't necessarily change if a market goes up, certainly not on the cap. If you look at that, the trends will follow it. They'll look not exactly perfectly correlated, but they're very well correlated. So that's where we are. So this is, everyone's used to this, and everyone looks at the exact same thing. This is Merc. So now, really the question is, what happened now? What happened this season? There's a bunch of stuff. Just let me tell you what we're looking at here. On the left-hand side, we took rack history. This is going back to the beginning of the decade, so to January of 2020. and we took suppliers in Bridgeport, Hartford, and New Haven, suppliers that you know well, and we tracked their prices every single day. You can see the lines. They trace each other very, very carefully, but they're not perfect. On a given day, someone's not going to have supply. There's a little funkiness when you switch from one product to another product, when you implement biofuel at whatever the level is, but you can kind of see how things move. The right-hand side, which is really where we should spend a little bit more time, the right-hand side is just the average of all of them. So nothing cryptic there, just it's cleaner to look at. So spending a second here, if we look at 2020 to 2021, we know we're in the throes of the pandemic and the impacts that the pandemic had. If you recall, that was everybody knows the famous $47 a barrel below zero, negative $47 a barrel for crude oil. But basically, product was readily available. Interest rates were very, very low. Demand was perceived to be and actually dropping in many ways. So what happened in that case is, despite the fact that it does cost money to move product from New York Harbor up to Connecticut, which is what this is referencing, we spent a bunch of time in 2021 into 2022, and then some pockets of time in 2023 again, where we had negative basis. You were able to go to the rack, the average rack in Connecticut in those three locations, and you were able to buy product at minus to the NYMEX. Awesome. It's great. I look for stability. Stability is the key for me, much more so than something being positive or negative. But just know that we've had negative times before. Clearly, and I do apologize if there's a little PTSD here, 2022 and 2023, Russia invades Ukraine. We see an immediate spike in the spring. It comes back down. And now, so we're clear, and I should have made this clearer. This is the differential. These other racks, I know I mentioned it, but this is not an NYMEX chart. This is the actual difference between the rack price and the MERC. This is the basis, okay, just to repeat that. So we had a blowout, and then things got, quote unquote, more normal. And then we had another blowout in the fall, and the world has gone on as if Russia and Ukraine are still not fighting any longer, although clearly they are. But things got back. We seem to have a tendency, and it's a great amount of resiliency that we have. We get past things and we kind of move on. The next couple of years, if I were in Connecticut from 2024, I'm looking at, rack differentials and, 5 cents over, 9 cents over, 10 cents over. It's kind of fine. And then, this winter kind of shows up. So what happened this season is it's a bunch of different things. And what will happen is I've always had this theory that when the market moves, the next day the reporting on the movement of the market is in relation to what the market did. When market prices pop up, it's because there was cold weather. When market prices sell off, well, it's because there's low demand. Now, both of those things might have been in play the day before, but it seems to be that the news reacts to the event more so than the event reacts to the news. Personal opinion, but I've seen it over and over again. What happened this year? All right, so we've all heard about the excess supply. We're going to have an overhang. OPEC Plus is going to have to cut back on production. There's going to be too much oil out there in the world. The economies of the world aren't strong enough. So we have this anticipation that there's going to be excess supply. Everybody's been talking about it forever. Brokerage houses, investment bankers, analysts, everyone's expecting this. Yet, it kind of didn't show up. Part of it might be that there is excess production, but it's stuck on ships that are floating at sea because Russian oil might have no place to go. So number one is this excess that we were expecting, didn't see it so much. Number two, thankfully, we're having a cold winter. I know the forecast for next week is finally to have something warm and maybe people are breathing a sigh of relief, but it's been cold. It started off cold. It's been steadily cold. Last winter was actually cold. It's crazy. Nobody believed we could have 2 cold years in a row, but we seem to be having it. So you have cold weather. You have excess supply, something that if you look kind of closely, the value of the U.S. dollar has dropped fairly dramatically over a period of time. Crude oil trades in most of the world in US dollars, that really means you need more dollars to buy crude that's produced overseas. So if that were in a vacuum, weaker dollar means higher crude oil prices. But again, I'm listing things. It's a bunch of different things. Then, again, it was really cold. You had snow, you had frozen, waterways, et cetera. And then there's been this overhang, and I don't want to say it's been a 47-year overhang, but certainly it's been getting tenser and tenser, certainly in June and July when it was the 12-day war. Iran. So all of those things are happening kind of at the same time. And that caused two things. Number one, it caused flat price, which we can call the MERC. It caused prices to go up. All right, what's the big deal? The interesting thing is, and generally it happens this way, when there's some newsworthy event that drives prices in a particular direction, the marketplace believes that news will go away at a point in time. I mean, case in point, we have rallied 80 cents a gallon in heating oil over the last week or two, let's just say. Next winter's prices have moved up only 35 or 40 cents. Oh, wait a second. Did oil just become a lot more expensive? Yeah, but things will be okay. And that's also what drives changes in basis. Short-term things drives the spot markets in a certain direction. That's how basis went negative during the pandemic. That was that, if you recall, the opportunity to fill up storage and lock in a good margin. When it goes the other direction, I mean, think about this. When Russia attacked Ukraine and things went to a tremendous premium, there was zero incentive to have any inventory. So almost a self-fulfilling prophecy, because I own oil that I can replace much cheaper a month from now or 2 months or 3 months from now. Let me just get rid of the stuff. Let me work on zero inventory. So those are things that are going on. If we look at the next slide, we can see it. Oh, here we are. This is this winter. And like I said, from beginning of September, we'll call that the start of the heating season. You popped up to a dime, but you were 5, 6, 7 cents. And then starting in January, it crept up, and it just stayed cold. This was without Iran. It just crept up. Interestingly, if you can see all the way on the right-hand side, you see it came all the way back down to zero. What happens is there's generally a convergence. A futures market is exactly that. So the prompt futures contract right now is the April futures contract. There is no March futures contract because we are in the month of March. So the April futures contract, you can't get that oil until April. So we're comparing localized racks with all their stuff that's going on, all the supply issues, all the fear issues, et cetera. And that's going on right now. But at the end of the month, when we get down towards the end of March, I am not making any predictions here, but the tendency is for futures and spot markets to converge a little bit more, because the 28th or 29th or 30th day of March, when the prompt futures contract is April, well, that's only a week. It's only a week away. You can see it right now. We're looking at it's a month away. So we came all the way back down, and you'll see that it's very, very common. It narrows at the end of the month. But then when the March contract expired at the end of February, which amazingly was only a few days ago, last Friday, and the bombing started over the weekend, the April futures contract became spot. So that bottom price that you see there, that bottom number on the bottom part of the line, is Friday, and the two jumps up from, call it 5 cents to 12 or 13 cents. That was just what happened over the last couple of days. Where it goes from here, you picked the wrong webinar. We are not predicting what the market's going to do. But I think we're okay on that, Danny, as far as what happened this year.
Yeah. Now, and if you can just go back to the previous slide, I have two questions for you to address, Phil. If you look at the chart on the right side, and this is based on a lot of conversations I've had with clients of mine who are probably on the call, and for other ones that would just want to know. If you look at the right slide, if I planted the word basis in that graph and asked someone, what is this? More often than not, they would say, oh, that's the difference between NYMEX and the harbor. And it isn't. It's the difference between NYMEX and the rack. The second comment that they'll make is the reason they said that is for many years, if you had a difference between the harbor and the NYMEX, if you wanted to know what was going on in the rack, so add 5 cents here, add 6 cents here. And what they're seeing now is not only are they adding so much more between the harbor and the rack, but it also depends on which rack they're going to, and they could be 20, 30 miles away from each other. Can you just comment on why that difference between the rack and the harbor has been such a big deal lately, and why we did this based on the rack instead of the harbor?
Sure. One thing, just to clarify, Danny, your clients are right. NYMEX or Merck to New York Harbor is a basis. Like I said, basis is not specific to this. So there is a basis Merck to New York Harbor. There is a basis Merck to rack. There is a basis rack to harbor. It's just a price difference. So yes. So now the question is, why did it get so extreme? It's a combination of things. There's some storage available in the harbor. There are spot outages that we've had, but it's been a matter, and obviously there's the component in some of the states. So the way I look at it is, yeah, in hindsight we can probably explain some of it, but I don't know if this is the appropriate time for it, but I would say this. I look at basis as something that should be mostly predictable and steady. However, there's always this thing lying like dormant, just beneath the surface, waiting for something to happen. Is this where you panic over it? No. Is this where you say, wow, I've been wasting my time hedging with NYMEX or offering programs or trying to do things versus the NYMEX? I don't care about the NYMEX. I only care about the basis. Absolutely false. You had a choice. If someone said to you, you only hedge one thing, or you can only go to your supplier for one thing. I want a Merck difference. I want this. Don't worry about the basis. Worry about the Merck. But that last mile, when it comes out, I mean, it used to be almost never, and now it's happening every year or two. So I'm not sure if that fully answers the question. It is unpredictable, and it is supplier dependent, and it is locational dependent. You can make the argument that the further inland, the more risk you're taking, because if it's not near a pipeline and it's not near something that can be serviced by the waterways, maybe that's a different story. There are a lot of different things, but I think your clients are kind of making the point of it's less predictable, and the rack is a more appropriate way to mitigate risk. Let's put it that way.
Okay. And the other one, which it allows me to, I should have done this before. I have a question from the audience. If everybody does look, they can see there's a Q&A at the bottom. You can click on it and you'll be able to ask a question as well. I am monitoring that, so if a question comes up, I can ask Phil. Also, which I should have said at the beginning, I just want to thank Navarra Marketing for helping us with this. Andrew and Bryce, bang up job getting this done with us. We really appreciate it. On the Q&A, what they just asked, which kind of leads to what you just said, Phil, and I know we don't want to give an opinion, but the question is as follows. Is 2024 to 2026 more than normal compared to 2020 to 22? And I think what they're doing is they're looking at this chart and realizing a lot more volatility for those years. Is that the normal now or not?
I mean, it's hard. Honestly, it's hard to measure. What happens is market has a way to self-regulate. So prices respond to volatility. Prices generally don't cause volatility. So I think what happens is that right now there have been big swings in the inter-month. So the contract, the difference in the different futures prices, that inherently will cause some changes. Right now, as we speak, the April futures contract is 25-cent premium to the May futures contract. That means that should nothing change, basis should be 25 cents added to what your normal distance basis should be. So, but that's today. I mean, we're in a crazy time. Would I say that the world is going to be like we're seeing right now in Iran for the rest of our lives, and all we have to do is become full-time traders and analysts? No, you got to be crazy. You got oil to deliver, and you got to make sure that you just don't get your asses kicked. I apologize for saying that, but I'd worry about the blowout. I wouldn't worry about the couple cents. Is it more volatile? It appears to me that it is, but I don't know. I don't know if it's going to change yet. The bio component, the distance component, the front to back Merck spreads, they all come into play, and they can all be painful or they can all be helpful. fact is that if you have a way to lock it in, which is something that we'll get to, if you lock in your basis at a certain level, you are also taking on the risk, and I put the risk in quotation marks, that the basis gets much better. If Connecticut has I'm making this up, there's no suggestions here, but if a Connecticut basis at the rack at 10 cents over the Merc is a good price, awesome. But there might be times where you could buy it for 6 cents under and you left 16 cents on the table. Am I worried about that? Probably not so worried about that, because yeah, you left some money on the table. You probably still made your full margin. I'm a lot less worried about that than it going from 10 cents over to 26 cents over. So yes, a little more volatile, but.
Okay. All right. If we can jump ahead 2 slides then, since we've gone through these. So what we have here is, it's a comment that we get from a lot of our clients. We did everything right and still got hurt. Don't want to make fun, but the question really is, what does that mean that we did everything right? It goes back to that status quo, in a sense, that when you're not necessarily looking at basis, so you didn't necessarily do everything right, especially when it came to covering your price protection programs. So can you give a little comment on that?
Sure. I mean, hedging 101, if there were such a thing, and I think that ship sailed decades ago. But your basic premise is you figure out what your cost should be. All right, this is what my cost should be. Whether you're going to your supplier, locking in a fixed price, and saying, all right, I'm going to buy some downside protection against it with a cost, that premium, as we'd call it. So if you were to take the supplier price with the premium, then you would say, all right, well, that's the most I should pay. That is somewhat common. I think more common. People are more used to buying call options and being able to shop around, because you don't really want to get stuck with the supplier. And I'll get to suppliers in a moment. But typical might be you buy a call option. So here's an example that we just threw out there. If you buy a $2 call option and you pay 20 cents, so your ceiling should be $2.20, but not really. Because if you know that you're in Connecticut and it usually costs between 5 and 10 cents more, logically you should say, all right, I'm going to say my cost should be, if the NYMEX goes over $2, I'm going to get money back. I paid 20 cents, that's $2.20. I have 5 to 10 cents worth of basis. I'm going to call it a dime. I want some elbow room. So I shouldn't pay over $2.30 a gallon. And I want, and before I get in trouble with anybody, I'm not advocating for anything, but I want a dollar margin. So I'm going to come out with a price cap of $3.39 a gallon, or $3.29 a gallon, or maybe $3.09 a gallon, and I'll charge a customer a fee to be a participant in the program. However you want to do it, this is normal stuff. What happens is you're assuming that middle one, the assumed normal supply relationship, it makes a lot of sense. But then if it blows out, if the basis blows out, and I cannot reiterate enough times, it doesn't happen a lot. It doesn't happen a lot. But when it happens, it can be very painful. Working as hard as our clients do, and having a month of January, we're on program gallons, and just, side note, program customers are your best customers. They, all of the data shows that if you have customers on a pricing program, capped more than fixed, but if you have them on a program, they are more likely to stay than if they're not on the program. There are other things also you can do. Service contracts are wonderful for stickiness. Budget plans are wonderful for stickiness, but those are your prime customers. When you have your prime customers, you love them, they love you. You can't raise your price. If you're at the price cap, if you offer this $2.99 cap and you're paying $3.19 at the rack, or not even $3.19, you're saying $3.45 at the rack when the NYMEX is at $3.19, you're not losing money on the table. Like David had said earlier, you're in a position you're going to actually be losing money on a delivery after your variable cost to make that delivery. So that's really what happened. The basis blew out, and it hurts right now.
Okay, so that explains on the program business, and I would agree with you, Phil, because what's interesting about covering for the basis as well, really from a mathematical point of view, if anything, or from a marketing point of view, is if you think about it, you're selling this to your customer and saying to them, we're going to give you a cap. So using your example, Phil, over here, where you're going to be at $3.09 and you'll pay $19 a month for the protection. And we know that when during the marketing part of it, when the customer says, well, what if the market goes down? I will have wasted $19. What I always say to my clients is tell the customer, yes, that's correct, but wouldn't that be great? And the best comparison, obviously, is to car insurance. We don't buy car insurance to be in an accident. We buy car insurance to not be in an accident. And Murphy's Law says you pay $1,000 a year and 4, 5, 6 years in a row, you're not in a car accident. All of a sudden, in 1 year, you're in two. And that's kind of what you're saying, that maybe it doesn't happen very often, but when it does, it really rocks you. So we tell our clients that and tell them, take these programs, you have the protection, and those end up becoming your most loyal customers. So what's interesting is, shouldn't we take the advice that we're giving our customers, right? The last mile, as you're calling it, Phil, is that basis that, yes, if you are getting basis protection, if nothing happens, then it's quote unquote a waste of money. And that's wonderful. It's exactly what we're looking for. But during those times when it really does rock our industry, you want to make sure you're covered. So I would agree with that as well. But if you can discuss something else as well. I've had a few people that have called me now that one that gives me the line of, well, this for our program business, 100% we need to cover the basis because we put a cap on it. We need to take care of that. We have a separate trading outfit for that, but they take care of it for them. But on their variable customers, they say to me, the answer is, listen, if the basis blows out, okay, so I add my margin to that. They have to pay a lot more money. And, I'll be fine. So I don't need anything from my variable customers. Almost in the same phone call, when I say, by the way, how's it going this year? Their answer is, well, actually, my margin isn't that good. I don't know. I seem to be losing a couple of pennies here and there. And I think that has a lot to do with also the fear of raising that price as much as they should. And would getting basis protection help that as well? So if you can give a little bit on that.
Sure. There are, and anyone that knows me knows there are a lot of reasons I don't wear a marketing hat. I talk too long and I just confuse people. But I would say this: we don't advocate speculation ever, but we do advocate predictable margins that makes your company the most valuable. So the notion of, if you're referring to, Danny, if someone who's holding the line at $3.99 a gallon, they just don't want to go up. They don't want to go up. Oh crap, I got to go up. Those points in time where you have to go up, it reaches a breaking point, and it probably is a little late. We don't like to go past that 79, 99, 09, whatever the number may be. The flip side is that if you do have a customer base that will always pay you that dollar over, and it's not going to impact attrition, and you can do a regression analysis on what happens when A and B and C happen. So you can take a look at what your attrition rates are based upon that. It makes sense to concern yourself with basis. I think you put it well, or your client put it well. 100%, you got to take a look at doing something on program gallons. But on non-program gallons, there's a lot of value to it, but it's also value at what cost. So if you raise your price when you break over the 99, you wait till it goes 2-3 cents. Well, then you don't want to spend a lot of money on price protection. If you wait 10 or 12 cents and then you have to do it, so it's a case by case basis. I'd put it that way. There's logic, but I couldn't give a simple yes or no answer on that.
Okay, so it can go in both directions. If we can go to the next slide, it kind of brings us to, in this year, you take the typical customer that sells 1 million gallons, and it was very cold outside. So hopefully they sold, 1,050,000, 1.1 million gallons. And if you ask any of them, oh, that's great, you did 10% more gallons. Did you make 10% more revenue, 10% more profit? In all those, the answer is no. And I think that has a lot to do with that we were mixing a wonderful season with a lot of pricing issues, especially, as we said, the basis issue coming up, and that did affect it. And they do have to be careful that not taking care of it just starts adding up to a hell of a lot of money.
Yeah, no, I agree. I mean, this was almost amazing, and again, for the umpteenth time, doesn't happen always. It just seems to happen at bad times. I will say this. I mean, Had we been having this conversation on today is the 4th of March, we were having this conversation on November 4th, there would be a lot of unhappy people, a lot of unhappy lenders, suppliers, bankers. It's late in the season, so it won't be so painful, but it has potential to be really ugly.
Yeah. All right. There are a couple of questions that came in, so I'm not going to wait till the end because this one I like. It kind of applies right now. Somebody by the name of Mr. Anonymous. With volatility, etc., is it worth forecasting or building out forecasting models internally? And I like what he brings up here to watch market pricing, supplier pricing, market/price drivers, and possibly weather to adjust pricing and margins and adjust annual budgets?
In a word, yes, not so easily done. I would use all of the facts that you had there. I would stay away from speculation. We do some supply advisory work, or we like to call it coaching. People don't like to pay for consultants; they like to pay for coaches. But we do some of that. But so the answer is, and we could do a separate webinar about it. Absolutely, absolutely yes. If you can build it in house, cheaper than doing it with us. But yeah, you got to look at all that stuff because it's not simply I'm going to sell 1 million gallons. You're going to sell 1 million gallons if your customers take 1 million gallons. If the weather is normal, they're the same number of HCDs. They distribute themselves. I mean, there were wacky things when you know, we have a client, just one little side thing, Danny. We have clients that they came into the month of January flat in their pricing program short side, meaning the obligations to their customers, and their pricing programs alongside the hedging that they had in place with a brokerage firm or with their suppliers or whomever. The month of January was really, really cold, and then they looked at the end and they went, well, wait a second, we're long. And, you know, everyone's scratching their head. How could you possibly be long? Well, you're long because the extra gallons that you sold in January ate up the gallons that were committed to by your customers, meaning that going into the month of February, the 1 million gallons you should have had left, well, they got deliveries of 80,000 gallons of that. So even though you still have 1 million gallons of hedging, you only owe, quote unquote, your short position, your risk position is only 920,000 gallons. That stuff, that's just one example, and I apologize for going off track there, but that stuff has to be looked at all the time. So yes.
Okay. And then this next question, we did want to bring up the idea you said, Phil, about we were going to talk about suppliers a little later. So the question they ask here, with spring around the corner, is from Justin, with spring around the corner, how aggressive should we be pursuing contracts for next year with vendors? Now, I'd like you to add into that, Phil, the idea of pursuing contracts in general and pursuing contracts compared to working with paper to leave yourself open to all the vendors that you work with, but always remembering that loyalty is important as well.
Okay, let's separate out a couple things here. I have no idea. No one has an idea what the prices are going to do next winter. So it depends upon when you come out with your program, when you do your stuff. I don't think it's overly logical to panic over something short term. If every year you start your hedging, you start your offerings in the month of March or in the month of April or in the month of July, don't try to pick the market. It's just hard. You'll be right sometimes, but you should not be speculating. So side point, next winter, next January, I'm just looking at the screen right now. I mean, next January is $2.50 a gallon. It's not a crazy price. I'm not suggesting it goes up or down from there, but it didn't move like the front month did. So on the should I do what I would normally do, or should I have this change my thinking? I'm in the camp of do what you normally do. Just steady as she goes wins the race. As far as suppliers go, suppliers have a hard job. We forget about that. They work really, really hard. They're not making $1 a gallon. They're making a lot less than that. And they have, it depends what you want to ask them. They always have to keep product. They want to be competitive. They want to just throughput a lot of gallons. They want you to pay on time or net 10, whatever terms that you have. They have a very, very hard job. They also have to compete against other suppliers. So what happens is when you, and I don't know if this is where you wanted to go, but I mean, I also don't want to run out of time here. Like, what do you do? I mean, part of the, what do we do here? Speak to your suppliers. I mean, ultimately, I think what we have clearly discovered, I think very clearly discovered, is tethering together supply cost to the NYMEX, to the MERC, can be very, very important to your business. Can your suppliers help you do that? In some ways, yes. In some ways, no. What we don't want to do is we don't want to force suppliers to be in a position where all of a sudden their supply desk is a derivatives trading desk where they have to worry about market volatility and supply demand imbalances and RINs and blend economics and putting in the hedges and what am I doing with the biofuels? All these things, they want to get product, they want to keep product, they want to sell it, they want to make their margin. I mean, not that they need me to have their back, but kind of like leave them alone. Don't pick on them so much, because if we're looking at ways to protect, there are paper ways for sure, and there are supplier ways. You can lock in a price, and then it's a supplier's job to get it to you. We find most of our clients buy a majority of their supply from two suppliers. They'll usually have 3 or 4, but the majority of the supply, 50, 60, 70%, will be from 2 suppliers. You got to shop around. Loyalty is incredibly, incredibly important. You know, you hear like, I'm gonna call my supplier up. I'm gonna beat him up because someone else is a quarter of a penny cheaper. Like, really? You know, you're in a business that only cares about loyalty. Is your price the cheapest? Is your cost of equipment the cheapest? Is your service contract the cheapest? You don't want someone leaving you over a negligible amount. So I think loyalty is really, really important. But there's going to be the day, and we see it. We're looking at rack prices every single day. We see the day where there are 4 suppliers, and one guy's just off his game or her game, and they're 8 cents more expensive than somebody else. So I don't know what the right number is to get from supplier number 2 or number 3, but it's not a quarter of a penny. So I think that suppliers have an important role in this continuum, in these dynamics. You need to sit down. I mean, we're happy to sit down with you, but you need to ask some very specific questions from your suppliers. You need to make them feel comfortable that you're not leaving them if the answer isn't yes, because very few suppliers can do this. But understand that when you're adding in a layer of complexity, you want to go, if you have a hedge, you want to go to the rack every single day and know that, go back to the beginning of what David said, the price was set last night. I want to go pick up fuel. I don't want to be surprised. So if you're saying my price was set a year ago when I put on my NYMEX hedge and I figured a nickel or a dime differential, I don't want to show up at the rack and find out that I'm paying 35 cents over. Is my nickel to a dime 11 or 12 cents? Yeah, I'll grant you the who cares, because you're not a wholesaler and it's not to an industrial account. It's to a homeowner. You can get the extra penny or 2, or if you can't, you'll live with 98 cents instead of 99 or $1. But the 20 cents, it's a kick in the stomach, and it happens. So that's kind of my thinking on that.
Yeah, and I think I agree that a lot of our clients will tell us that when we're working on this stuff with them, the supplier very much appreciates that we're taking care of these issues outside of the supply part, and they can just do what they're supposed to do. And it becomes a really, really nice partnership between them. So it just makes your relationship better by doing things with us instead of saying to them, I need supply, and by the way, I want to be protected up the wazoo with A, B, C, D, and E. It's just going to cause some issues with them when it could be taken care of this way. It's getting a little late, so why don't we go to the next slide, which is at the end, what can dealers do? And we've covered some of this. You can see the 3rd bullet point, Phil, is ask the supplier the right questions, which you said. But if you can do this more as a review slide, I'd appreciate it.
Yeah, so I mean, basically, let me just touch on one thing. It sucks when you get the midday price change. I've seen a lot of schemes. I don't mean scheme in the negative way. I'm going to say scheme like a Britain, which is just a plan. There are different ways to hedge. Some of them are viable, but a lot of times, again, it's just static, just short-term noise. And then, we've had conversations like, why did the supplier raise the price? They should have done their hedging, and then last night the market settled at XYZ. I'll tell you why. Because what happens is you should understand this term, a fuel oil dealer that's sending a truck to the rack every single morning, say just one load a day, 3,000 gallons, that dealer almost always has what they call optionality or a free option. Because what happens is this: if you go to the rack and you load at a normal price and prices spike up, well, you don't want to pay a higher price. You want to just load again because you know tomorrow morning prices are going to be much higher. So you load up your truck in the afternoon and you just don't go to the rack in the morning. Or prices collapse during the course of the day and you're going to fill it up in the afternoon, but you wait till the next morning. It's always up to you. So to take that away from the supplier and say, no, you can't change your prices, it's inherently unfair. I know suppliers do have intraday pricing. They have online portals. Use them. Have a conversation with them. Speak to them about who's wet, who's not, where you can get product and where you can't. But don't chase intraday noise. There are paper trades that you can just do something every single day year round that'll protect you against an intraday price spike. We can talk about it. I'm happy to. Probably more speculation than anything else, but they do exist. So intraday noise doesn't happen all that often. It is part of life. You can hedge against that with some storage. Not everybody has storage, so conversations to have. You need to know your terminal stuff. When we run into a client that says, "Yeah, I buy from one supplier in this location." Well, for how long? Forever? Do you shop around? No. The mindset there is, this is what my cost of supply is. I'm not suggesting the supplier is ripping you off, but come on, look around a little bit. Understand what your basis is. Understand the basis in the area. There are hundreds of terminal / supplier / throughputters. Just make sure you're in the game. So don't chase the intraday noise. Know your historicals. We can help you with that. And ask the right questions. If I know of, I have one client that has like the perfect setup as far as the basis goes. It's a very, very large company. Most companies won't get that. They're a multi-state company, but typically speaking, you just have to understand what's going on. We can't bury our head in the sand and say, "Oh, well, look at that. Over the weekend, prices went up 35 cents a gallon." I guess they just did. Well, if the NYMEX went up 10 cents a gallon when the supplier went up 35 cents a gallon, someone's eating that quarter. So that's my comment on those things.
Great. Okay, so I know we are past 11:45. Everybody is still on looking at participants, which is great. If certain people have to leave, I understand, but if you guys can stay on, there were a few more questions that came in, and I just like to get to them, and certainly it'll be worth listening to. So, Phil, the next question that came up, the answers are yes. I'm not sure if you can discuss it on this webinar, even if we're allowed to, but aren't most of all hedging contracts against NYMEX? How do we hedge to the local supplier level? Can we do that?
The answer is yes. Most trading is against the NYMEX. There is a very robust derivatives world. It's a matter of customization. I said I am not wearing my marketing hat, and I am certainly not wearing my regulated trading advisor hat. So I would say the answer is yes, but it really requires a conversation.
Yeah, and certainly everybody on here, as it says here in the orange, and of course, schedule a review with call with Angus. That's less a marketing ploy and more a way to answer what this person just asked. It can't not necessarily be
it's marketing. It's marketing,
like
Danny. Just admit it.
Say it again?
It's marketing. Just admit it.
Okay, fair enough. But in all honesty, to answer those questions, we would love to speak to you about it. It's just not something that can be brought up in a webinar like this. The next question was, prices jumped over $1. I don't know if it's $1, but certainly it jumped a lot over the last couple of days. And this person's looking forward. Should I be doing anything different with my deliveries?
Wow. That comes back to probably the earlier question of analyzing things. So, standing here, I can't just say, because I don't know enough about your deliveries. And all we do in our consultative roles is we try to be on your team, making some suggestions, but there are too many parameters to answer that question. What I would say is this: if you want to just take a step back and just take a long look at this thing, if you believe that, or you can effectuate that, you can make a delivery at a point in time in the future and have the cost of that supply be dramatically lower than your cost today. And you can either lock that in or understand you're taking on a risk, and you're pretty damn sure that the customer's not going to run out of fuel, because saving 50 cents a gallon and having a run out is not going to make anybody happy. So the answer, case by case, would be yes. Depends upon the K-factor, depends upon the base load, depends upon the forecast, depends upon the usable tank size, depends upon the tank reserve, depends upon whether or not the tank has a monitor. It's not an easy yes. Well, it's an easy yes, but it's a yes where I am just requesting that nobody says, well, Phil said push off all deliveries. There's an asterisk with a lot of fine print on the bottom.
Yes, these are conversations that we have with our clients all the time, and it is on a case-by-case basis, because what is their volume? Where are they located? What's the breakdown of their various businesses? How are they delivering? How many trucks they have, et cetera, et cetera. So there's a lot of good answers to it, but it needs to be discussed. The next question, I'm going to add to a second part of it. The question was, do suppliers have any protection against the basis blowouts or continued backwardation? And I'm going to add to that question, or for sake of the relationship with your suppliers, are you better off taking care of it outside of the supplier's realm?
Okay, that's a bad question. I mean, it's a good question, but I don't know. I don't know what suppliers do. I mean, I know, I'd like to think I know what I would do if I were a supplier. I don't know that backwardation necessarily matters to them. It depends for what. If they are a spot market supplier, like I said earlier, if you're in a position where you can buy oil every single day or whatever your product is and mark it up $1, well, then you don't have basis risk. If a supplier is taking their cost, I mean, it could be on a FIFO basis. I mean, it depends how they're doing their inventory management, et cetera, but just real basic. They're buying a barge, they have it a few days later, they put it into their inventory, you send your truck, they're going to pass through their cost. So I don't know that they have risk. Are there ways to manage it? Sure, but like we said earlier, like, why would they? They're in the wholesale business. What was the second part of your question, which I liked even less?
That was my part of it, so it's okay they didn't like it. Just saying is, for the sake of the
Oh, are they
relationship with
better
the
off?
supplier, is it better off doing it outside of their realm?
I mean, I don't know. I mean, if a supplier can give you what it is that you need to give you that hedge that you need, that perfected hedge. On one hand, you're giving up your flexibility to go to other suppliers, but you might not care because it might only be on part of your volume. So are paper hedges better? I mean, they offer greater flexibility and liquidity. All right, there's a lot of liquidity there because a paper hedge isn't going to run out of product in a terminal, and they can be customized. They can be cost efficient, but you're in the market. So I would say it has to be discussed. I would say often that would be the case, but I don't want to be dismissive of the opportunity that our clients or that anybody has in trying to see. You have to start it off this way, Danny. What is the goal? How do I best get there? If you're starting with what are the choices there, what do I have out there, then I want to figure out where I'm going. No, start with your goal. What is your goal? If your goal is to avoid a basis blowout, then we have to find the best way to do that and see if the best way is affordable, see if it's reasonable. If there's a 40-cent basis blowout, you'd be foolish to spend 40 cents to protect against that. So it's case by case, but case by case has to be discussed.
Sounds good. Okay, I would like to get this done by 12 because although people stuck around for another 15 minutes and most did, I don't want to get into their day much more. If you can go to the next slide. Just to close this out, as I had mentioned before, like car insurance, you don't think about basic protections until something happens. And it's really the reason that we gave this. Yes, we got lucky with everything happening, and what a great day to have this webinar. But regardless of what happened this weekend, and if basis calmed down to the point where it didn't exist by this morning, we would still be giving the same webinar. It's an important thing to take care of. We do need to understand that. You never know when it's going to happen, and therefore be protected. So with that, David, if you would like to close it out, I would appreciate it.
Yeah, well, thank you, Phil and Danny. I think our objectives are met to give advice to marketers on this very important topic during these tumultuous times. And as you said, this is a general webinar, and for personalized advice, be sure to call Angus or your supplier. Thank you.
Sounds
Awesome.
good. Thank you all very much.
Thank you all very much. Have a good day, and watch the margins.